Most people think retirement fails because markets crash or because they didn't save enough. But for families with 1 million to 3 million saved, that's almost never the real problem. The real problem is this: the tax rules quietly change. And a few normal, innocent decisions like taking an IRA withdrawal or selling an investment or doing one Roth conversion can trigger a chain reaction of higher brackets, Medicare penalties, Social Security taxes, and even a tax bomb for your kids. For those of you who are new here, welcome. My name is Robert Cannon, president of Xperity Wealth. For over 35 years, I've helped professionals and families move from saving for retirement to actually living in it. And what I've seen again and again is this: people don't lose retirement because they made reckless investment choices. They lose it because they walked into tax traps they didn't even know existed. In today's video, I'm going to show you the 5 hidden tax traps that hit hardest at $1 to $3 million level, why they show up even if you've done everything right, and one principle that prevents them, what I call income orchestration or tax timing. By the end, you'll know exactly what to watch for and how to protect the money you spent decades building. So most people at this level feel something strange. On paper, they're successful, but emotionally, they're uneasy. The fear shifts from, will I ever have enough money, to, what if one mistake and I lose what I've built? And the problem is this: at $1 to $3 million, the tax system becomes interactive. One decision can trigger multiple costs at once: higher brackets, more Social Security taxation, Medicare surcharges, even a legacy hit for your kids. This video is especially important if you have heavy pre-tax balances in 401ks or IRAs, receive pension or real estate income, plan to claim Social Security soon, are considering Roth conversions, or think, we'll deal with taxes later. Here's the key line I want you to remember. At $1 million to $3 million, taxes don't rise because Congress changes the law. They rise because your plan hit a trigger point. Let's start with the biggest one: required minimum distributions. If 70 to 90% of your wealth sits in a pre-tax account, RMDs can create forced income you never planned to take. And when those withdrawals begin, they stack on top of your Social Security, stack on top of pensions and rental income, push you into higher tax brackets, and remove your flexibility later. This is where the math turns against you. You can now be forced to withdraw more than you actually need to live on and pay taxes on money you don't even want. That's what I tell clients. RMDs aren't the problem. Unplanned RMDs are. The good news is you're not powerless here. There are 3 levers that give you control. First, Roth conversions before RMD age, done gradually inside the right brackets. Second, distribution sequencing, choosing which account funds your lifestyle each year. And third, real tax diversification, so your future income tax isn't trapped in one taxable bucket. Because if you don't manage those levers, rising income sets off a chain reaction. And the first place the chain reaction shows up isn't your tax return. It shows up in your Medicare billing. Medicare premiums don't depend on today's income. They depend on income from 2 years ago. So a big financial decision at 63 can punish you at 65. Common triggers I see all the time: one large Roth conversion year, selling a concentrated stock position, a real estate capital gain, a single big IRA withdrawal for a remodel or gift. What feels unfair is this: your spending didn't change, your wealth didn't change, your Medicare costs jump anyway. The principle is simple. You don't avoid conversions, you avoid conversion spikes. Coordinate income with IRMAA thresholds. And this is exactly why planning matters most before these decisions happen. If you're within 5 to 10 years of retirement, this phase where the right strategy can save tens, sometimes hundreds of thousands of dollars. At Xperity Wealth, we help clients map out RMD exposure, IRMAA risk, Social Security taxation, and smart conversion ranges, so you're not guessing. If you like help understanding how this applies to your situation, your income, your accounts, your timeline, there's a link below to schedule a conversation with our team. Now let me show you what happens when income rises the wrong way, because the next trap doesn't just increase taxes, it changes how your Social Security itself gets treated. Social Security taxation is based on something called combined income, which means pulling $1 from an IRA can cause more than $1 to become taxable. RMDs, pensions, dividends, conversions, they all stack together. Couples get hit especially hard once both start benefits. It's a double hit. You pay taxes on a withdrawal, and it makes more of your Social Security taxable. The fix is coordination. Social Security claiming strategy, bracket fill withdrawals, choose the right account to fund your lifestyle. And if income climbs high enough, guess what? There's a stealth tax that kicks in on top of everything else. The net investment income tax. It's a 3.8% surcharge tied to MAGI thresholds. And at this wealth level, it can be triggered by capital gains, dividends, rental income, or a Roth conversion that pushes income higher. I call it a triple stack year. Higher bracket, plus IRMAA, plus the net investment tax. The solution again is orchestration, timing the gains, asset location, smoothing conversions year to year. The last trap doesn't just hit you, it hits your kids. Under today's rules, many heirs must empty inherited IRAs within about 10 years, often during their peak earning years, which means larger pre-tax balances, larger tax bills for your children, a legacy far less efficient than could have been. And as I tell clients, you did the work, but the IRS get paid twice. Once through you, then through your kids. Legacy-aware planning looks at Roth conversions with heirs in mind, beneficiary alignment, and charitable strategies when appropriate. Here's the main idea I want you to understand. The biggest mistake isn't paying taxes. It's paying them at the wrong time. At 1 million to 3 million, the goal isn't maximum growth, it's control. Retirement is not an investment problem, it's an investment in tax timing problem. So let me share you this hypothetical client we work with, who in their early 60s, about $1.8 million saved, $1.3 million pre-tax, $500,000 taxable. When they first reached out, their plan was simple. Just wait until RMDs and deal with taxes later. But the numbers told a different story. If they stayed on path, they were facing higher tax brackets in their 70s, Medicare IRMAA surcharges, more of their Social Security becoming taxable, and a significant tax hit for their kids under the Secure Act. So we helped them redesign the strategy. Instead of waiting, we used bracket managed Roth conversions in a low-income years, controlled MAGI to avoid IRMAA spikes, built a clear, predictable income plan, and positioned assets to create a more tax-efficient legacy. Today, they're spending with confidence instead of hesitation. And here's the key point. Nothing about their investments changed. Only the strategy did. And that's really what all of this comes down to. At this stage of life, success isn't about finding a better fund or taking more risk. It's making smarter decisions with the money you already have. So, if you're approaching retirement and wondering how to keep taxes lower over time, how to avoid IRMAA and RMD traps, how to protect your Social Security, how to leave money to your family efficiently, that's exactly what we do here at Xperity Wealth. You can schedule a conversation with our team using the link below, and we'll help you see where these traps might exist in your own plan. And before you go, watch the new video on your screen, why everything changes for retirees with 1.5 million saved. In that video, I'll break down why this level of wealth follows a completely different set of rules, why saving more can actually start working against you, and how to know if you're already financially independent, and if it doesn't feel that way yet, because the goal isn't just to retire, it's to retire with clarity, confidence, and control.